welcome to Dad Gives Advice. My name is Orestes, and in this video I'm continuing my series on investment vehicles. Remember that when I cover these things, I'm talking in very generic terms, and so you shouldn't take anything I say as specific advice directed at any individual. Anything I say should be taken only as informational or educational in nature, and you should consult your personal financial advisor before taking any action. In this video, I want to discuss options and how they work. I'm only doing this for completeness sake and to educate the viewer on these things because I really don't like them, and really they should be reserved for hedge fund managers and people like that want to protect against their positions going in the wrong direction. And generally speaking, they can be quite dangerous and you could end up losing quite a bit of money in options. But because they're so dangerous, I thought I'd cover them just to be safe so that you understand that they're out there and they should be avoided. Options are traded on exchanges with bid and ask prices, just like stocks, but they don't represent direct ownership in stocks themselves. They derive their value from stocks, and that's why they're called derivatives. Most major stocks have options trading on the market all the time with different expiration dates, like those shown in this screen capture of an Apple option chain. So what is an option? An option is a contract between a buyer and a seller. And this contract enables the buyer to trade a stock, to trade 100 shares of stock at a specified price by a certain date. This specified price is called the strike price. So you'll hear me talking about the strike price. And this date is also called the expiration date. So you'll hear that as well. And these future trades can be of the buy or the sell variety. An option to buy a stock at a future date is called a call option. So that will allow the buyer to buy stock at a certain price by a future date. An example of that is I can go into my brokerage account and buy one contract to buy Apple stock at $155 by August 26th. And that, based on this screen grab here, would cost $455. And because one contract controls 100 shares, that would cost me $455, or that $4.55 times 100. And now what that means is that I now have the option to buy 100 shares of Apple at $155. Now, if Apple is currently trading at 150, then of course I wouldn't buy it for 155. The whole point of this is that the buyer of the call is hoping or thinking that the stock will go up to the strike price or beyond. And as the stock goes up, the premium that they paid, this is called a premium, by the way, the $455 or the $455 per share, that premium actually goes up as the price of the stock goes up. So these kind of go in line with each other. There's also a time premium. So I'm not going to get into that in too much detail, but there's also a time factor here since there's an expiration date. As you get closer and closer to the expiration date, the difference in price isn't as great because your option is about to expire. But anyway, just to keep it simple, this gives me the option to buy the stock at 150. If it's at above 150, of course, I wouldn't exercise the option. I wouldn't go ahead and try to get somebody to sell it to me for 155 because I'll be losing money. And the point is, I'm hoping that the stock goes above 155 so I can profit from that. The seller of the call, remember, whenever there's a buyer, there's also a seller. The seller of the call is hoping that the price of the stock stays below 155. And by the way, a seller is also called a writer. So the seller wants the stock to stay below 155. And if it does by the expiration date, then that seller keeps that premium. will pocket the 455, and that's how the option writer makes money, by being able to pocket the premium if the stock never gets above the strike price. Now, let's say the stock did go above 155 and it was trading at 175 before the expiration date. In that case, I'm now what's called in the money because I have 155 option. So I can exercise the option, and what I'm doing is exercising the seller. The writer now has to sell me the stock at 155, and I make the difference. I make $20 a share, or $2,000, minus the original premium that I paid, which was $455, for a profit of $1,545. And that's how you would make money on an upside of a call option if the stock actually went up before the expiration date and you were able to exercise the option. Another way to make money in this way is not to exercise the option, but just to simply sell the option itself, sell the call on the open market, because the call, when you bought it, was at 455 at when the stock was at 150. It might be, it's 660 or something when the stock is at 175. So you can just sell that and make the difference between that and profit in that way as well. In either case, the seller of the call is the one that is on the hook for that difference, for that profit that was made. Because remember, he had to sell you the stock at 155, so he has to make up for the difference because the stock is actually trading on the market at 175. So in that case, the seller of the option is losing a bit of money. And that's one of the reasons why options are so dangerous. Call buyers' risks are limited to the premium paid. Your option could expire worthless, and that's what the call seller is hoping for. If August 26th in this example comes around and the stock never went above 155 and you didn't sell the option before then, you will lose the entire $455 and the call seller will pocket that money. The downside is even worse for call sellers because their risk is technically unlimited. If the stock goes really, really high in that time frame, the call seller can be on the hook for a huge amount of money. I'll give you an example. In this example, if the stock went to say 300, I could exercise at 155. And long story short, the seller of the call would lose $14,500. And theoretically, their loss potential is unlimited. Like the stock could go to the moon, like they say. And if for some reason this company announced something gigantic or huge earnings or what have you, and the stock went to 1,000, that's a huge loss. It can go to 2,000, whatever. Stocks can go up a long way before they come down. And so call writers are in a very sticky position if they stick with those calls for an extended period of time and the stock gets away from them. The other side of the coin on options is called a put. And in this case, you are buying the option to sell a stock. So this is the option to sell at a price by the expiration date. And in this case, the put buyer is hoping that the stock goes down, and the put writer or put seller is hoping that the stock will stay where it is or go up. If the stock goes up or stays at the current price and doesn't get down to the strike price, then the put writer will just pocket the premium. If the stock falls below the strike price, so let's give an example here of, say the stock is trading at 50 and you buy a 45 put expiring by, let's say, August 26th, then if the stock goes to say 40, you're below the strike price. The buyer of the put profits by $5 a share, the difference between the 40 and the 45, and the put writer is on the hook to pay that difference. For a put, the buyer's exposure is the entire premium paid. So if they paid a few $100s for the option to sell the stock and the option expires worthless because the stock never fell to the strike price or below, they would lose their entire premium. That's their downside. Their upside is if the stock goes really far down, all the way to zero technically, then they could make a lot of money. They could make however much it fell times 100. And the downside for the put seller or the put writer is the opposite. They would be on the hook to pay for that entire drop in price should it fall a long way from, let's say, 50 to zero or what have you. And the put writer's upside is the premium. If the stock doesn't fall below the strike price, they pocket the premium. By the way, I've been talking in terms of 100 share lots, And that's one contract. People can trade multiple contracts to control more than 100 shares. So you can talk about, 5 puts or 10 calls or 100 puts or 100 calls or what have you, so that you can control more than just 100 shares of a stock through these option contracts. But for simplicity, I've been talking simply about 1 put or 1 call contract per trade. Bottom line is that these things are very risky and there's a lot of exposure on the downside, especially if you're the writer of one of these contracts. Options can be used as a hedge against a stock that you currently own going down. This is called a protective put purchase. Let's say you bought a stock at 25, we'll call it ABC stock at 25, and currently it's trading at 55. And so that's a nice profit. You've made $30 a share, you're happy, but you're not sure whether the stock is going to continue to go up. Maybe you see some signs that the market is weakening and you don't want to sell because maybe it'll continue to go up. You think maybe there's a chance to keep going in a positive direction, but you do want to lock in profits at a certain point if the market turns against you for whatever reason. And so in this case, you might want to do a protective put purchase. The way that would work is you would buy a contract, you buy a put at say 52, expiring in a couple of months, let's say September, I don't know the date, it would be a Friday. All contracts expire on a Friday, but I don't know if that's a Friday, but let's, for sake of argument, say it is. And in this case, what you're doing is you're saying, I'm going to let this stock rise up. And if it goes up, then your put is going to expire worthless. So let's say you paid, I don't know, $200 for this. And it's like paying an insurance. If your price continues to increase on your stock by the end of September, and this expires worthless, then you lost $200, but you didn't sell and your stock kept going higher, and theoretically it could be now at 75 or so, and now you've made more money and you didn't sell prematurely. If the stock were to go down, that's where the insurance comes into play in this scenario. If it does go down to below 52, you can now sell the stock at 52 to at least lock in the profit that you have between where you buy it and that 52 point. So you see how that works. It's kind of like an insurance that lets you ride the market higher, but if the market does go against you and goes down, at least you lock in some profits. Now, this isn't free, of course. You do have to pay that premium, and if the stock keeps going up, you do lose the premium. And if you do this again, and buy another option that expires in January and so on and so on and so forth, you could end up doing this too many times, and these premiums could end up eating away at that profit. So you have to be careful there as well. There's also an income strategy for stocks that you own with options, and that is called a covered right. And let's say you own 100 shares of a stock, ABC stock, call it, and it's trading at 50. Let's say you bought it at 30 and you've made a bit of a profit. And it's trading at 50, and you could try to make some income off of that by writing or selling calls. And the way that works is you would sell 1 call at 55, say above the current price. And what that does is that the buyer of the call is paying a premium. It's saying they're paying you a couple $100. Again, just for the sake of argument, let's say it's $200. And you're getting that money. And if your stock never gets to 55 or above, then you pocket that $200. And you can keep doing that over and over and over again every couple months with new contracts that you write. And that could work out really well in your favor if this stock never gets to this price. Where it could work against you is if the stock does get to 55 or above, then the call buyer may exercise the option and will require you to sell your shares at 55. So let's say if the stock goes to 70, you will have to sell your shares at 55 to that option buyer because they're going to exercise their option to buy the stock at 55. Now, you still made a profit. If you bought it at 50 or if you bought it at 30, whatever, you still made the difference between 55 and wherever you bought it. So you still made a profit. But now you no longer own the stock, And if the stock keeps going up, you miss out on all of that other gains. And you missed out, of course, on the difference between 55 and 70 as it went beyond the strike price. So that could be risky as well. You might miss out on upside when doing covered writes. There are many other esoteric ways of using options out there, like straddles and spreads and ratios, but they're a bit complicated, and I'll spare you the dizzying details because I don't like options to begin with. So I would just say stay away from those strategies. That's my summary on options. I don't use them because I think they're very risky, and because I use index fund investment strategies, they don't really come into play. I just wanted to cover them to make sure that you're aware that they're out there. When you hear people talking about calls and puts, you know what they are. Hopefully you'll learn from this how risky they are and you don't start getting into them at all. Let me know if you have any questions on options or if there are any other topics you'd like to see me cover. Thanks for watching and have a great day.